Welcome to the Business Extra. I'm Mustafa Al-Rawi, Assistant Editor-in-Chief at The National here in Abu Dhabi. With me is Kelsey Warner, The National's feature editor and co-host of the Business Extra. Hi, Kelsey.
Hey, Mustafa.
So we're talking about markets today, energy markets, commodity markets. It's been an interesting year so far as we kind of come to the end of the second quarter, the first half, and we're going to get into the discussion of where things go.
Right. It's a week that began with the G7 meeting and will end with an OPEC meeting. And so with prices feeling volatile, statements being made crossfire all around the world seemingly on the state of oil and the energy markets, I think an interesting time to check in with a friend of the show.
Exactly. We're going to talk to Ole Hansen from Saxo Bank, he's head of commodity strategy there. But before we do that, do subscribe, or if on YouTube, you ring that bell. Joining us is Ole Hansen. Ole, thank you so much for being with us.
Thank you very much for having me.
We talked earlier in the year when there was quite a bit of volatility in markets, but it'd be interesting to hear your take on where we are now. In particular, the last few weeks, the narrative has been about, is a recession likely? And as a result, investors have kind of been up and down over it. How have things been for you?
Well, as you say, very volatile. And I think what's different this time compared to previous experiences of high volatility that I've seen in my time, and I've been around for quite a while, is the fact that this is really hitting all three sectors this time. We've seen elevated volatility in agriculture and industrial metals, and as well, obviously, in the energy space. The energy market is probably the sector holding up the best. You mentioned recession, and that clearly has become a key focus in the market since the higher than expected CPI number on June 10th, which led to this big interest rate hike the following week by the FOMC. And this is really where we are right now. The market is just trying to work out: are central banks going to successfully in bringing down inflation, i.e., by killing growth through higher rates before we get in time to get inflation down, before we have a setback in the economy. And that's really the worry right now, that we may see a recession before inflation comes down, and that's obviously the very dreaded stagflation, and that will obviously have an impact on some of these commodities. But again, the energy sector remains well shielded. I think we need quite a dramatic drop in demand, really, in order to see also a dramatic price drop, because the market just remains tight. We're seeing these OPEC meetings you mentioned this week, and in recent months, these meetings, sorry to say, has become quite irrelevant, because we know what they were going to agree. The meetings become shorter and shorter. The elephant in the room, Russia, has not really been addressed, and their ability or inability to meet their targets, compared together with a lot of other producers. So we currently have a deficit of more than 2.5 million barrels on a daily basis, compared to what OPEC Plus originally had envisaged they would produce, and that's really what's keeping the market underpinned. So I'm keeping a very close eye on fuel prices, diesel and gasoline, more than crude oil, because obviously the pain right now for you and me as a consumer, that's not the price of crude oil, that's the price of the petrol at the pump, and that's really where we've seen the pain, and these prices remain very elevated. And
they will be durable even against a recession, is sort of what you're predicting here.
I think they will, perhaps not in the short term, because we have to remember, this market is not just oil producers and consumers. There's also a lot of financial investors involved in the middle of this, trying to take their investment decision from macroeconomic developments. And if we do see if the macroeconomic picture deteriorates further, we will see some short selling or some hedging in the oil market. Investors basically trying to hedge themselves against recession by going short some of the growth dependent commodities like copper and oil. But in general, the supply and demand ultimately will prevail, and that I think that part of the equation still will remain quite tight, especially also in years ahead. And I think the conundrum, the one question we keep being asked on a regular basis, well, why on earth doesn't these oil majors just go gung-ho blazing into drilling for more oil, because the profitability is fantastic? Well, it is if you have oil available for delivery today at $100+. But if you're looking at the forward price of oil 5 years out, it's around $40 to $50 lower than where we are today, and that's really the price they need to look at in order to work out the profitability of making the new investment, which potentially won't generate income for a number of years. And adding to that the whole uncertainty about the future demand of fossil fuels because of the green transformation, then it just really too many uncertainties that prevents them really from taking the decision to increase investments.
Sorry to interrupt, but can we really say that is still uncertain? We already have snapped back to pre-pandemic levels in terms of carbon emissions and demand for fossil fuels. It feels like I'm getting skeptical of that uncertainty increasingly.
Well, it's rightfully so, but I think this is like the nuclear arms race back in the 50s and 60s. It was driven by political will to be superior on the weapons front. Now we have another arms race called the fight against climate change, and that's politically motivated, and that basically means that the will to drive through changes over the coming years, not probably accelerate by the Russian aggression in Ukraine, which is obviously, especially here in Europe, has left us in a massive pickle, that because we're paying punitively high prices for all the energy that we consume, that the need for this transition has if anything been accelerated by these developments. So 5 years out, we will see a peak in oil demand potentially sooner than expected. But I just saw the BP, they came out with their annual review earlier today. It's a fantastic publication for a massive amount of information. And just looking at something like the electricity consumption last year, obviously going up, and the part of that going up the most, the production of that is coal coming out of China. So again, it's a long-term process, but again, these oil majors, they need to think 5 to 10 years out. And right now, the crystal ball is just simply so blurred, so shady that they can't really, they don't see anything clear right now.
You mentioned that unless there was a massive drop in demand, that you didn't see sort of energy prices collapsing. But I think we've seen in the last couple of years that we can't rule anything out. But very unlikely. Maybe the big question mark remains about what's going to happen in China, because we don't really have a clear picture in terms of demand since they've had this up and down regarding COVID resurging, and they've had various lockdowns in cities across China. Now it looks like it's easing. They've even recently shortened the period of quarantine for inbound travelers. But as long as China is focused on a zero COVID policy, and you've seen various disruption in Hong Kong and other parts of Asia, then there could be a drop off in demand. It's not impossible. I mean, do you rule it out completely that the demand could soften considerably?
Well, demand has softened, especially in China in recent months, and I mean, I wonder where oil price would be if we hadn't had that softness, and if we hadn't had that 1 million barrels almost a day coming out of strategic reserves in the U.S. Then prices clearly would have been significantly higher. So I think we've seen some softness already. But you mentioned COVID, and right now I'm starting to see colleagues being struck down with the second round or third or fourth round. Again, it's not serious, but at the same time, it does highlight the risk that we're still not in the clear across the world, even though we've been vaccinated and so on. So that potentially could be a theme in the autumn that again, temporarily could have a soothing impact on demand, but you would almost have to argue that we need that soothing impact on demand, because with supply being struggling as it is right now, with Russia, Libya, Ecuador, and several OPEC Plus members struggling to ramp up production, then that really is the only way we can have a relatively stable price. And we've seen in the past that the old saying, the best cure for a high price is a high price, because high prices kills demand and it incentivizes production. And right now, if we only got one part of that equation working, i.e. it kills demand, then without incentivizing production, then really we need to see the demand slow down in order to make sure we have a bit more balanced market and avoid these price spikes, which no one likes, because it will prolong the period of high inflation. It will prolong the economic pain from rising interest rates. And again, from a production perspective, it's not a long-term viable solution having energy prices at these high levels. It's very good in the coffers for now, but the long-term risk is obviously for lower revenues from lower prices.
What are you hearing in terms of the market's attitude to this idea that the G7 could move to cap oil prices? Is that something that market's taking seriously?
No. To the straight answer to that, I just simply cannot see how it would work, and I don't think they know themselves. It's obviously, if you want to, if the idea is to try to reduce Russia's revenues, then obviously that could be a route they could go. But I simply cannot see a global open market how you can achieve that without basically everyone agreeing to it, and clearly that's not we have a very divided world right now, split into many different camps, and so I don't see this as I see this as something that they would like to do, but you can almost sense behind the scenes that, well, they don't really know how to effectively to implement it.
I mean, it's not easy to regulate global energy markets. I mean, OPEC, look at all the deal making and the discussions and everything they've had to do, the OPEC plus wider alliance. So it's interesting that the G7 is even discussing the possibility of them becoming sort of almost an Uber OPEC, higher than everybody else, and deciding, where prices sit. And actually, for years and years and years, OPEC have always said, we're not trying to set the price, we're trying to maintain stability. And where G7 are concerned, when they're coming in now, they have a very, very narrow purpose for what they're trying to do. And I don't know, as you said, if the market's not taking it seriously, that gives me a bit of comfort, I have to say, because I did think about it and think this sounds implausible.
Well, just to add to that, okay, so the one meeting we haven't yet talked about is President Joe Biden heading for Saudi Arabia off of the G7. What are the expectations from that?
Very low,
right?
Very limited. I think the only thing that could, the only thing that, well, the Saudis they'll continue to increase steadily as long as they can, and as long as they still have spare capacity left, because the last thing you want as an oil producer is to be left without spare capacity, because then that could almost be taken worse by the market than adding oil, because then suddenly we'd have no buffer left if there's another crisis suddenly turning up. So I mean, we have a few. They're probably not that low hanging because it require a lot of political camels to be swallowed. But we have low hanging fruit with regards to Iranian production and Venezuelan production. Iranian most focused on, because obviously Venezuela's oil industry has been run down completely, so they need billions of dollars and probably a number of years before they can get their production back in gear. But Iran is low hanging fruit with regards to sanctions, but we obviously know the relationships within the Middle East and how difficult potentially that could be to achieve. But maybe a discussion about the wider political situation in the Gulf and what potentially could make the Saudis more acceptable, or make it more acceptable for the Saudis to potentially make a deal with Iran that could increase production.
Well, I mean, we're at kind of inflection point. It's almost a case of if it's going to happen, it's going to happen really fast or not at all. You mentioned the Saudis and the Iranians. There's been discussions via the intermediary of Iraq, helping that move along. There's even been sort of wider discussions across the region in terms of allies. We have the Negev summit recently, looking at how to counter Iran. So there's a lot of diplomatic movement. And so Joe Biden's visit kind of comes at a time when if a deal can be made, it will probably be made now. Otherwise, we might be sitting around for a long time to see any momentum again.
Yeah, that absolutely. And but then overall, we know that the relationship has not been the best for quite a period of time here, which is obviously unhealthy when you have the world's biggest consumer and the world's biggest producer in a market which is as volatile as it is right now. So just the fact that they actually meet face to face is always a good thing.
You talked about gas supply. I mean, we'll come back to Europe a little bit. You're saying that something like 70% of supply is out of the market now. I saw you tweet that. Is that actual picture right now in Europe?
Well, it with regards to Russian flows, it is, because we're down around 70% compared to where we were this time last year. So the biggest part of that drop just has occurred within the last couple of weeks, and it basically means right now that Germany is almost running dry on gas from Russia, because the Nord Stream pipeline, which is the main artery taking gas into Europe from Russia, besides the ones going through Ukraine. But the main pipeline into Germany is the Nord Stream, and that's down 60% of the flow, and the remaining 40%, quite a lot of that is already earmarked for countries like the Czech Republic and so on. So Germany is feeling extreme heat right now from that. Electricity prices are hitting record prices. We have an old respectable company like BASF, basically struggling with some of their production because it is very high energy intensive. And again, what's up and down in this situation from the European perspective, it's geopolitics. Russia trying to squeeze the Germans. From the German perspective, from the Russians, it's basically Siemens hasn't delivered the spare parts for a pumping section that they require in order to do maintenance. So I don't know what's up and down in this story, but if we continue this kind of rate, then we will struggle to get our storage levels in Europe back up to around the 80% that has been targeted, and with LNG increasingly becoming an important source of supply. We have to remember when it comes to that, we are in a global competitive situation with Asia equally also showing strong demand, especially when and if China gets out of its lockdown, and you will see demand for that picks up. It's not looking well in Europe, and we're caught in the middle of this right now, and what we will see and what we have seen already is that we're getting to that demand destruction side right now, where some industries and some are basically forced to reduce demand because the input cost is just simply too high. So yeah, it's a tricky situation, one that we can all feel in our pockets.
I'll ask you this last thing, Ole, before we let you go. Given that we're wrapping up the first half of the year, what are your kind of main points that you're looking ahead beyond the summer, even for 2022?
Well, we've been talking a lot about energy, which is obviously crucially important to the global engine. But I think for the global stomach, I'm really focusing a lot on the food side of things, food security. We have seen a little bit of easing of some of the worries recently. There's been quite a big drop in something like edible oils with palm oil coming down. But we really need the Ukraine situation to stabilize. We need Ukraine being able to export its excess grains before the new harvest arrives, because that requires space in the silos. And right now, quite a lot of these are pretty stuck with old production that they need to get rid of. So I sincerely hope that we get a solution to that, so we at least can get the food situation a bit more under control than we've seen in recent months. But generally, the second half I think will be more of the same in terms of energy. I think the recession or the economic slowdown will not be strong enough to really have a major dent in terms of global demand. So that basically means we will continue to see tight markets. And on the industrial metal space, once we get China up and running again, I think the market will again just switch their focus from demand worries to supply worries, just like we're seeing in the oil market. We have to remember we're down 30%, the industrial metal index since the peak in March. But global inventories monitored by exchanges in London and Shanghai has continued to come down during this period. During this period, we have inventories now of the four major industrial metals at the lowest I've probably have ever seen. Obviously, that's not the whole picture, but it just tells you that this lower prices due to lower demand should translate into higher inventories, and we haven't seen that. So I see industrial metals also having a recovery here into the second half.
Ole Hansen from Saxo Bank, thanks so much for being with us.
Thank you very much.
Well, that's it for today. Kelsey Warner, thank you so much.
Thank you.
And all that remains to thank our production team and you all for being with us. Join us again next time.